Welcome to First Line Compliance's Carefully Off the Cuff.
Hi everyone, I'm Josh.
And I'm Ray for First Line Compliance. Today we have a guest, Justin Smith from NContracts. Justin, why don't you tell us about yourself a little bit?
Ray, Josh, thank you for having me today. Justin Smith from NContracts, been in the compliance space for over 20 years, specializing 15 of those years in fair lending, redlining, and CRA compliance. Have the opportunity to work with over 4,200 clients across the country within NContracts in the fintech space. So once again, thanks for having me.
Well, great. Then you're probably one of the perfect people we need for our conversation today. Today we're actually doing part of our mini series of what we call the F files, which is really about fair lending. And really the objective is to talk about fair lending from top to bottom and how it can affect the shop and what you can do. Today, we're going to be talking about what I would call the micro fair lending portion, which is in your shop, what can you do to do fair lending analysis? And I know that there's often conversations about needing to do that. How do we do it? It looks pretty expensive and difficult to do and a lot of data and takes a lot of time. And in fact, I think in some balance of that, I would say it's actually none of that. So really the objective is I think you can measure your fair lending and actually look for opportunities of doing things better in your shop and getting more opportunity for business by actually looking at your data. So really we're trying to take the mystery out of doing fair lending analysis. So that's the goal today. In fact, let's start with it, Justin, if we could. One of the things that can seem intimidating often is just the fair lending speak, particularly when it's the analysis. We're talking about all these terminologies, regression and statistical and blah, 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 and we don't know, it gets overwhelming. And I thought maybe you can kind of explain maybe quickly what those terminologies might be and really take the mystery out of it. And it's either not a big deal or it's solvable.
Sure.
What do you think?
I think, Josh, when we were chatting a couple of weeks ago, Josh and I were talking about, if you're not looking at your data, you're the only one, not to Josh's statement, but it really is. The consumer advocacy groups, the regulatory community, academia, news outlets are all pouring through the data. And there are different methodologies that we use. It could be something as simple as an Excel spreadsheet all the way to building very complicated regression modeling and just about anything in between. But I do think the importance is to look at your data. And Ray, as you said, it can be a little bit of a journey, but we don't have to boil the ocean to start with. And so the first thing that we would recommend is just doing some baseline analytics. And that's basically taking your data and doing simple calculations, like is one group more likely to be denied than another? Or we could get deeper in to that world where we are doing regression modeling and controlling for variables that you would utilize to, say, underwrite or price a loan. And we can get deeper here in regression.
Just to call it out, to connect some of the terms of art. So the first test we were talking about denial disparities.
Yeah.
Disparity testing is a really common component of fair lending testing. When we start looking at other areas of regression, we're looking at different levels of statistical analysis. But Justin, will you walk through, I think it's helpful sometimes to just give those connections. What do the term of art mean and how does that come into practice? So like match pair, statistical significance. Talk to us a little bit about what those words mean.
Sure. I think when people hear the word statistics, they reflect back to college and they have anxiety.
Exactly.
So, we in the fair lending world, we apply statistics a lot, but even in what I would call baseline analytics, and that's basically where we would take your data, we would identify protected classes, so groups like African American or Asian or Pacific Islander or Hispanic or female, age 18 to 62. So we're looking at these and we're stacking those up to the control groups, white non-Hispanic or male borrowers. And we're looking to see in plain terms, is there disparity in data, whether it be is one group more likely to be withdrawn, is one group more likely to experience a denial? And we can use statistics there, even though we're calculating a very simple ratio of a 1-to-1 ratio. We can still use statistics to tell us whether we have a confidence in our observation. And so we'll look at things like the size of the sample of the data, right? Are we looking at one application, or are we looking at 10,000 applications? It's kind of like flipping a quarter, right? The more you flip that quarter, you go, okay, we're going to be closer to that 50-50 mark. And so we can use statistics, or you may have heard terms like p-values or z-tests and t-tests. And those, once again, even in very simple calculations, can guide us whether we can trust our observations.
But the upshot is, I don't have to do the calculations, do I?
Right. Yeah. I mean, there's all sorts of tools. I would recommend this day and age using a tool. Of course, NContracts, we would love to be of assistance, but I think there's obviously folks out in the market. And I think that the benefit of using a program designed around fair lending is it is going to aggregate your protected classes. It is going to aggregate your control groups. It's going to have these types of disparity analyses built into the programs, but then most of these applications will have that statistical component within it to tell you whether you can trust these observations and then proceed with your mitigation strategy. It really it's a big time saver. We're not going to chase things that we don't have a lot of confidence in the data.
So if I had two things and one of them is something else, it's not like, oh my gosh, it's half and it's statistically sound. One of two really isn't good statistics, is what I'm getting. You really need a good deep. Okay. So, but let me ask you then, because we talk about regression. You mentioned regression analysis. I'm sure it's significant, certainly important at a certain stage, but I mean, what I understand from regression analysis, it's not necessarily the first thing we have to start with. Going back to, you said, just give me your data. I'm assuming you're talking, just give me the HMDA data and let me play with it. Does that make sense?
I love regression. I manage about 100 projects a year in that, but regression is very efficient at helping us understand the credit decision or the pricing of loans. But what regression, because there are variables related to those, but what regression cannot help us do is process information. For instance, the redlining conversation. Do we have appropriate application flow? Or it can't help us understand, is one group more likely to withdraw than another group? Quality of service, or be incomplete, coded in the HMDA data, or do we have timing disparities? And so once again, a very valuable tool, but Ray, I always recommend take the data from a baseline perspective and get the broad picture, the broad understanding of your data, and looking at probably 12 to 15 different angles first before we just go down the path of having a credit decision or a pricing conversation.
Okay.
I'll just add in, because I think particularly helpful here, one of the values or one of the benefits of using one of these fair lending tools is its ability not just to slice and dice the internal data, which to your point, one of my favorite sayings, if you're not looking at your HMDA data, you're the only one. You need to know the story that data tells. You need to have that narrative built around why you may have differences or what's unique about your business versus another. But one of those benefits in using the tools is not just the data within my walls as a lender, but what's happening outside those walls. And so let's maybe talk just a minute about peers. And I know that can get a little bit confusing, or depending on who you ask, maybe there's some subjectivity to that, or maybe when a regulator is challenging your performance, their version of a peer may be different than yours. But I think, can you talk just a little bit about the ability to do the comparison type reviews, as well as maybe what a peer is and how those peer groupings or rankings get developed?
Sure. Peer data does two things. One is it provides us context or understanding outside of our walls, right? We can look at the peers and we can understand that if we have a 2x multiple of a protected class being more likely to be withdrawn, and we can look at the industry and say, okay, well, the industry's at a 1.5. So we're running hot. It provides context to us. You see globally what that looks like. Or peer data, we can understand that maybe we have a 1% denial rate and the industry tends to hover around 15%. So that's an interesting conversation. Provides context to us. The other component that we really leverage peer data from is to manage the redlining conversation. We've all seen a lot of settlements. 2022 has been a very busy year in the industry. And when we look at that, the good news is we look at it by geography, and we look to understand, are there majority minority census tracts? And those are census tracts where over half of the population is minority. Just because census tracts exist doesn't mean that there is a lending appetite, though. There could be lower owner occupied rates, things of that sort. So the good news is that the regulatory community does then look to that peer data for context. And they do compare or benchmark you to how other lenders are doing in those communities. Now, Josh, to directly answer your conversation, there are multiple methodologies at looking at that peer data or defining your peers. Now, I think we all would agree that looking at that data in aggregate shows the true lending appetite of a community, right? It's all in, it's every single application in that community. It's going to be hard to argue with that. But we may not have a great market presence, or other people may not. And so one of the things that we commonly see in the industry is called 50 to 200% methodology. And basically, if you had 1,000 applications in a market, they would look at other lenders that have 500 to 2,000 applications. On occasion, we will see it based on origination volume. There are other instances outside of the 50 to 200 that may be unique to your institution that you would need to think through. That may be agency selected peers. I was working with a client last week, and they only did manufactured lending. And so it was a very viable reason for them to exclude other types of lending and only look at manufactured loans to understand how they were performing. So there are some others, and then on occasion you may see where it's self-selected, where an organization only picks 4 or 5 or even 10 or 12 very specific organizations. I think you do open yourself up to some exposure there, because you selected those and the regulatory community may not agree with that. But I think you want to pick a path and be consistent in that approach.
Right. Well, and I appreciate that. I think really what we're defining here, the terminology, et cetera, high level, the upshot to me is when I was in house, especially, it's like, but I don't have to know this stuff because Justin does, right? You'll explain it to me, understand, I'll understand quick enough, but I don't need a PhD in this language to understand. And I think that's great. I think really what I'm hearing is, give me your hum the data, let's get started. And I'll tell you what we should be looking at. And I appreciate that.
Ray, real quick, let me follow up on that. I think it's a really good point. You saw my face when Justin said statistics.
Yeah.
You don't need to be a statistician to be able to be a good compliance fair lending officer, or to be able to pick up the picture that the pieces of your puzzle are telling you. And that's really the takeaway I'd like folks to walk away with. Look at your data. Start to understand what story it's telling. We need to internally know what's different, what's the same, and why before we're asked. If we understand it and we see that there's a problem, correct it. So target it and understand where that is. But if we're not looking or we're not analyzing the data, we miss that opportunity. And the first time we're going to have to try and create that narrative or tell our story is when we're being accused of breaking the rules.
So that's actually a good transition, Josh, because one of the things I want to cover is how to look at the data, not like the details and the terminology, but I know that there's a tendency to say, hey, the expectation is we're going to take a look at the national data and even our national peers, as it were, and look, we're not doing bad overall. It's like, yes, but I have a sense that those who want to see how we're truly performing are not going to look at the overall. They're going to look a little more entire minutia. So certain census tracts, whatever, certain areas, vulnerabilities, et cetera. They're going to look at different ways to cut the data. So don't get comfortable with the national data that you have. Look at it from a different prism. And Justin, what do you think about that, and how would you do that?
Yeah, I think especially in the redlining world, right? Looking at our lending across the country at how we're serving minority tracts really doesn't resonate. We're going to want to focus on how are we doing in Miami-Dade County, right? How are we doing in Richland County? Or how are we doing in this MSA? Because the underlying demographics or the census tract makeup does shift. And so you really do want to peel back those layers. But Ray, in addition, when you're looking at these disparities for credit decision or pricing, I think the key is to understand if do look at maybe by region or by market. We've seen settlements where it's maybe one bad actor or specifically an individual LPO or a branch that's causing the heartburn, and unfortunately the organization as a whole pays for it. And so I agree with you. You do want to have the ability to kind of peel it back and have that inquisitive nature if you feel like you do have risk. I mean, this is a very risk-driven conversation. What guardrails do we have in place? And so being able to dig in by branch or by region is very valuable.
I think it's important because I think it's how people look at the data. But
Ray, let me just follow up on that a little bit, because I think just to drill in a little further. So to the extent we're analyzing a particular MSA, where are we looking? What are we looking for? When we're looking at our own internal data, what are we identifying? And I really want to challenge industry to look at it two ways. One is, yeah, there could be a challenge. If we're looking at it, we may identify something in the data that doesn't paint a pretty good picture. The other perspective is the opportunity. And I want to get through a couple of the levels of HMDA analysis or looking at the data, but I also want to come back to, and a friend Rosalind Hardy just mentioned this the other day, as we're looking at the shifts in volume of the industry, it's important to start climbing the trees. What I mean by that is it's time for lenders and originators to start not just gathering the low-hanging fruit, but to go out and find the people who want the loans. And the people that want the loans may not be the borrowers that we've historically reached out to, the easiest to reach, the ones we've had in our books of business. But if we're going to take the market share that's available, we need to reach new borrowers. And the way to do that is exposure or penetration into those markets. So needing to understand the makeup of those markets lets us know what markets to go into. One other just really interesting stat, Mike Frattantoni was giving some presentations in economic, Mike Frattantoni, obviously the chief economist at MBA, looking at the projections for volumes. And it was from 2003 projected to 2025. And I'm going to get the numbers wrong, but roughly for last year, volume was over 2 trillion. It was over 4 trillion. This year, we're going to be just over 2 trillion. Next year, looking at about 1.9 trillion. When you go back to 2009, there have only been 3 times where volume was over 2 trillion. So next year, when we're talking about the lowest volume we could see for a long time, is still a top 5 volume over almost the last 13, 14 years. So the business is out there. We need to know where to find it and how we find it.
And I think that's a key point as far as we're looking at this not to how are we doing badly performance, but what opportunities do we have, and let's go get it. I think that's true key for true leaders and would notice that. So I appreciate that. So
thank you. And I had to give that commentary.
No, you go ahead. I know.
Even though we're focusing on nuts and bolts,
tell, Josh,
the bigger picture.
You were itching to say it. Go ahead.
Couldn't help myself. But just to talk through quickly a couple of the elements of the type of analysis I would be doing, or we help lenders go through when they're looking at their HMDA data. One is pricing disparity. If we're looking at the APR of the loan, if we're looking at lender credits or discount points, and we're looking at exceptions, are exceptions tracked? Do we have a legitimate reason to understand why a borrower may have a higher APR than another? Did the borrower have a down payment assistance program? Do we have a way of tracking that in our data so we can explain it? Are there geographic differences? Are there legitimate, legally justifiable business reasons that are understandable to explain why someone's loan may be priced differently? Similar on denial rates, and Justin mentioned this. Are you seeing differences in your borrowers that are denied, and do those denials tie into any protected class, whether that's ethnicity, race, sex, age? I think all of those are really important to try and track. And the other one that was mentioned, but just to drill in a little bit more, withdrawal rates. In today's market, we're seeing statistics that borrowers are leaving contracts or not moving forward with purchase contracts at higher rates than they have in the last several years. Is that why someone's withdrawing? Because their offer didn't accept it or they decided not to buy it? Or Do you have a practice where you're seeing a higher percentage of withdrawals than you historically had or than your peers had? And that's just because LOs are leaving the company and you didn't know what else to do with the loan to get a disposition. The first is a better narrative than the second. If we look at our data and start to see that there's a variance, we'll be able to better determine the why. And the why will help us dictate our narrative or tell our story so that we're consistent internally and externally.
So Justin, let me ask you, this is just my experience in having done this a long time, is that I suspect that, I know the denial rates are an issue, but a lot of times we're stuck with the credit policies we had because they came from Fannie Freddie. So, we don't deny. If we, in fact, we can do a loan, we will. Everybody wants to make money. I'm guessing that we're going to see more things in pricing disparity insofar as being controversial and maybe more opportunities to fix. What are your thoughts?
I would agree. In the non-depository world, the credit decision itself is going to be somewhat limited for discretion. Let's put it that way. We can't put in a depository institution. We could put things in portfolio, make some more exceptions. This is a lot of this whole conversation of fair lending revolves around discretion, right? And so if thank goodness there's discretion, we may be out of a job if we didn't have it here. But
sure.
I think that, Ray, the two, I would agree with you that yes, that's going to be limited. I think we still need to look at it. I think that, to pick back up on Josh's conversation, quality of service has been a big concern over the last 2 years. Most organizations were running very, very wide open. And are there preconceived notions about the interaction they're going to have with the borrower? Or can they qualify? Are they doing first in, first out? Are they trunking files? This year we have had a little bit of a downturn, but we have had a reduction in staff. And so once again, it goes back to that quality of service. I see a lot of concern about that. And in addition, I agree with you, Ray, pricing, and then of course, redlining. So that's kind of what we're seeing in the industry.
Yeah, I can tell. I mean, with pricing, I think people, again, a lot of this is innocuous. We mean well, right? We have that borrower that we have a good rapport with and has done refinance before. And so we, as you said, discretion is like, hey, I'm going to get you, see if I can get a pricing reduction on that. Do you do that equally with everyone or just people with whom you identify? And that's kind of the question. And that's where it's like, look, I didn't intend to, I understand you didn't intend, but the result might be statistically others out there didn't get those opportunities. I think it's the, as you mentioned, it's discretion is where, like you said, is where we stay busy. If it weren't for discretion, there wouldn't be any risk. And I think that's where the risk often is where you have discretion points. We need those discretion points. I'm not opposed to that, but then you need to control for them, like doing fair lending analyses. So that's kind of what I think. And I think you said the withdrawals, I think, are part of the key things now. People are, you can see how I think, and I noticed there's more questions about withdrawals from regulators. And it really is a matter of why are they walking away? Are you not paying the attention, not responding as quick? So versus somebody you identify with and so on and so forth. So those are my things. I get that. Josh, I see you chomping.
Yeah, dying on this one.
Yeah.
If you have discretion, you better have documentation.
Yep.
You better have a way of understanding or communicating how that discretion is not implemented on a prohibitive basis or having a negative impact or a disparate impact. Even though your intentions may be good, are the outcomes potentially causing unequal results that have a negative impact on any of a particular protected class?
Right.
I think that part is really important.
And
and I appreciate it. So we're taking the types of reviews, and again, the overall fair lending and the pricing, and certainly withdraw. But I'm sensing more than this. We've talked about fair lending, but there's a new element that's coming out. And I want to say it's new because Josh is going to tell me it's not new, and so will Justin, I'm sure. But that's kind of like language proficiency, the context and characters, the backgrounds of the borrowers themselves are changing, and the expectation of how we treat them and address them is changing. So to that extent, Josh, why don't you start off? And what do you think about that? And Justin, see if you can chime in on that.
Ray asking me to talk about language proficiency.
I know. I set that up.
Now you're speaking my language.
I know, just spike it. Go ahead. No pun intended, right?
Really good point. Let me suffice it to say, and for folks who talk to me, you've obviously heard me talk about limited English proficiency and where the industry should go, needs to go, is going. The short part is, given the household formation statistics of the population, population growth statistics of the country, where we are now and where we're going, by people way smarter than me, like the Harvard Center for Joint Center for Housing at Harvard.
Well,
Can't even say it. I'm not even smart enough to say the name.
Yeah, right. You're not qualified, man.
Clearly. But even for someone unqualified, for me, the data tells such a clear story, even I can get it. And what that data shows is household formation and population growth for white non-Hispanic households is negative. Population growth and household formation is largest amongst Latinos and often Spanish-speaking, followed by Chinese, and the only group larger than Spanish-speaking are multicultural, multiracial. So what that means is, if we want to be serving borrowers, borrowers are telling us a clear message. If you want my business, speak my language. That is the component of language preference. That to me is a much more important business requirement, business opportunity, but it does have some compliance challenges. Where those compliance challenges are, the reason they're becoming more front and center is largely because of a couple of pieces. We have the SCIF, the Supplemental Consumer Information Form, that will be required as of March of next year, that will ask consumers for their language preference. We have the IRLA with the expanded demographic information, where the borrower can self-identify, not just are they Latino or non-Latino, but can further identify as Mexican, Cuban, or write in the additional information. We also have a lot of demographic data that holds true. So let me just throw out a scenario. We have our originator, Lupe Garcia, who, by the way, on our website and business card says hablo español. And you have a borrower, Ernesto Chavez, who happens to be applying for a loan in the San Joaquin Valley in California. For those of us not in California, one of the highest concentration of Latino populations in the country. Within his application, he identifies as Spanish speaking, or as a language preference of Spanish, and self-identifies as Mexican in the demographic data. From the outside looking in, Spanish was spoken on that transaction. So as lenders, are we providing an experience? Do we have a way of meeting the borrower's experience to provide services in Spanish? And from a compliance perspective, you're in California, there's Civil Code 1632 and 1632.5 that say you must provide translated disclosures. In other states outside of California, there are concepts like unconscionability statutes and UDAP requirements that, to paraphrase, say, I speak to you only in Spanish, I give you documents only in English with no other way to understand the key terms, risks, features, benefits of your loan. Good chance that was an unconscionable trade practice that's deceptive. Contract is invalid, free loan. What are we as industry doing to, one, pay attention to the shifting demographic curve, and how do we make sure that we stay in business by serving this population? How do we provide a borrower experience that's in line with the hundreds of billions of dollars industry has spent to provide a digital mortgage and an improved borrower experience? And then how do we make sure that from a monitoring perspective that we're meeting the fair lending and compliance requirements that go along with it? So just as one last piece to throw on, and I know I got to take a breath. There's been a lot of potential, or a lot of discussion around the SCIF that's required in March. That's the language preference collection. Also required in March is the requirement to transfer fair lending data for servicing, which includes language preference. So unequivocally, language preference is now a data element in a loan servicer's file that we will need to make sure that we capture and transfer so that there's better continuity of service between origination and servicing. Okay, I'll take a breath.
Yeah, so you take a breath, I know, and a swig of your whiskey. But Justin, that tells me that fair lending is actually going to get more complex in some ways, because now there's extra questions, extra data, extra expectation by borrowers, and of course, consumer groups and even lenders, regulators about this. So I suppose it makes it more important to manage your fair lending. Anything you see as far as with limited, with the language proficiency issues coming up, how it's going to affect maybe fair lending a little bit, or certainly the significance, and then maybe fair lending and servicing. Have you seen any of that? So those two things, what do you think about those?
I think globally it points to how important consumer advocacy is nowadays, and how the folks are aware of it and they have outlets to file complaints. Now, I think the consumer is more educated. Josh, I think Josh really nailed it though, is that I was doing some reading earlier this week, and I think they said 9% of households have limited English proficiency in them. And then I've seen some other studies that are way higher, but I think it's a magnificent opportunity done right. It presents a lot of business opportunity for folks. There's no doubt going to be a fair lending intersection here. That this is the direction of that. It is one more data point. It's if it's collected, it's going to be analyzed,
Yeah.
and it can be analyzed definitely from a fair lending perspective. Once again, a quality of service perspective of like a pre-screening or a treatment. I mean, that's why we're doing this, right? And then, when you get into the servicing side, we know that servicing's the number one complaint. That's going to be where a majority of the complaints that are filed to the Bureau are coming from is related to servicing. So now you can imagine one more component to that. And so it's going to be an interesting, start next year, the next 12 or 18 months for folks.
So I agree with that. I think it even gives more texture to fair lending, and more reason, and as we say, actually more opportunity. We just have to be ready for it and invest in it. But I think there's tremendous opportunity there as well. So we just have to know where it's going to be. Now, to be clear, I know we talk about data and fair lending, and that's how we can. And people look at your data and they can tell us how you're performing in fair lending, and of course we can as well, and match pair. All that's well and good. But I'm also sensing that we talked about it, that there's other ways to check how you're doing and how you're treating people, and that's making a phone call and doing a shopping thing. And what are you seeing out there?
Yeah, I think the consumer advocacy groups are once again very aware that easy way to get a grant, right? That's one way. I mean, you can there's some things, and so they're good at looking at data nowadays. Data's publicly available. The Bureau's made it easier to access. They can slice and dice, but getting out there and doing mystery shopping is a way. And we've seen there's a settlement earlier this year. I think it slipped below most folks' radar. It was about $75,000. But to speak to that, I think when you look at that, it revolved around one branch and specifically one loan officer. And it was just a different treatment or a different experience for a protected class borrowers. And I think that stresses the importance of having a good compliance program, but making sure that your training is done annually, and it is front and center for people. And it does include that, hey, it's not just the credit decision, it's not just how you price a loan. It is, people do need to be reminded, it's how you treat borrowers. Unfortunately, there are still preconceived notions out there, and we've got to break down those barriers. But there's a lot of risk. And so as a large organization, I can only imagine trying to think through all your LPOs and all of your loan officers, but training is one way. The other thing that I think that you need to have within your compliance program is a strong complaint management program. And do your borrowers know how, can they find how to file a complaint? And if the complaint is filed, where does it go? Is it handled? Oh, we handled that at the branch, or does it make its way back centrally to compliance? And are we monitoring that? And are we looking for patterns? And so mystery shopping is very active. And I think that once again does stress the importance of training and a good complaint management process.
Justin, let me follow up on that. I 100% agree, and you said it. I'm just going to throw a phrase to it. Have you taken corrective action? I think that goes to complaint management. I will tell you, with some of the settlements and cases that are pending and settled this year, as we've talked about, what's in your email or text messages or advertising, what a group of loan originators might think is funny banter, a regulator or someone outside might consider offensive or discouraging someone to apply. And if there is that type of conversation that's in the email and the company becomes aware of it and doesn't do something to correct it, they're seen as condoning it. So lenders need to make sure that we're looking for that type of thing. And if it happens, we're taking steps to fix it and to show that while there may be this incident, it does not provide evidence of intention to discriminate.
Yeah, and I think, so you really need to, it goes back to leadership and management. We need things in place, like you said, and it shoehorns into the fair lending piece. It's not just the data, it's how you treat people, which starts the data, right? The data is the result, it's the manifestation of everything else we talked about. So if you flip it on its head from the training and the complaint management, we can do that as well and say, you do all of this right, your fair lending is going to be right? It's a lot of it anyway. So
a lot of the data is black and white. Sorry to cut you off, Ray. A lot of the data is black and white.
Yeah.
That's the empirical component. It's everything else in the picture that's gray that we need to be able to define so we can tell that.
Now again, like anything else though, it's like, whatever you put in place is appropriate for a company of your size, right? So, but you gotta do something. You've got to move the needle on complaint management. You've got to move the needle on training, and you got to move the needle on coaching people or catching people if there's any issues that come up. And of course, you gotta move the needle on looking at your data, right? And there's good ways to do it. So to wrap it up, and I just want to make sure that everyone.
I was going to say, talking about moving the needle.
Exactly, we're moving along, right? So moving along, I think there's a lot of things we've talked about here, particularly what I greatly appreciate, Justin, for you explaining and taking the mystery, not shopper, the mystery out of a lot of this. It really is. Look, it's getting together and getting a good coach and support, like either first line compliance for what we do, or certainly. A company like NContracts that understands the data and can move it and give some guidance. That's probably going to be a key. Any thoughts, Justin, just finally, insofar as what people should do and look for and put us at peace and simplify the whole process, take the mystery out of this?
Yeah, I think having, just distilling it down, and we've talked a lot about, but I think having good, well-defined policies, procedures as it relates to fair lending. And then can't say it enough is doing something with your data, anything, looking at your data. Josh, you just talked about emails and identifying things and not taking action. So, right, one thing is looking at the data, but then if there are disparities, finding the answers. And just because there's disparities doesn't mean there's discrimination. So once again, there was a settlement earlier this year where the disparity was identified, but no action was taken. And so, look, we need to look at our data, and we need to be willing that if we do identify something that we're outside of our risk tolerance, we need to be able to take action, or we need to be able to go find the answers that explain it. They're more often than not are answers there. And so we just have to be willing to do that.
Okay,
I said that's a mic drop.
Yep. Yeah, exactly. Mic drop. Exactly. Can't even say much more. Get
Justin,
a fair lending coach. That's what I hear. Get a fair lending coach, right?
There you go.
It'll make your life easier. You can smile, you understand it, but you don't have to do the heavy lifting, and it's a lot easier and much more approachable than you think. And I think that's the key message we have to get to leadership at mortgage companies. So any other last words, and we'll take it from there.
I just want to, Justin, thank you so much for providing your time and your guidance and your insights. Really valuable. I think super helpful for me and hopefully for everyone else watching. To everyone else out there, thank you so much for giving us your time.
Yep.
Please rate, subscribe, review. We'd love to hear your feedback. And thank you guys so much for watching.
Thank you, Justin, for your time. I greatly appreciate it. Thank you.
Wonderful host. Thank you.